so you should have an opportunity to ask a question or two. I'm going to ask you, because there are 3 sources of media in the room, and if you really want your bosses to know you were here, I'd ask you to please identify who you are, who you represent. You get 2 seconds to promote yourself, and then ask the question and direct it to whichever. David, I'm going to ask you to run the microphone for whoever puts their hand up first. There we go. Well, I knew it'd be a lawyer.
I'm not going to stand up. Brian Reeve at Castlesbrock, lawyer, so introduced. In terms of each of the 3 of you over the next 5 years, let's say 5 years from now, a quick comment on interest rates, more or less the same as they are right now, higher, lower, whatever, price of oil, and the Canadian dollar.
You're both looking at me.
I'm happy to jump into this. So the list was interest rates, the Canadian dollar, price of oil. Okay, so 5 years out. Where do we want to start with this? Let's go with the oil prices first, because I think the sequence plays into that. 3 years ago, I debated a couple of the chief economists on Bay Street. And we were sort of at a nexus point. Where are commodity prices and the dollar and interest rates all going to go? So we're up on this podium there, and the street was squarely in the camp that, okay, when a recovery happens, commodity prices go up, commodity prices drive the currency, so the currency is going to go up, so we're going to be in this parity plus world. And I said, I don't see things that way. The way that we look at quantitative easing is it's flooded the world with liquidity that has nowhere to go, and it's ended up in parts of the market that have mispriced assets all over the place, and commodities are one of those. So I think, well, the logic behind their arguments was true if you believe in yesterday's prices. I did not believe in yesterday's prices, and I believe that tapering has proven that when the liquidity gets a little bit more constrained, you start to see commodities and other financial instruments on the periphery of the market actually coming down. So our forecast at the time was oil prices are going to head down. We don't think that there's a supply problem. Guess what? They're down even though we have geopolitical problems in the rest of the world. That's what a spike in prices does. It brings throughput into the marketplace that doesn't necessarily flood the market, but let's be real with ourselves here. The economy is picking up and oil prices are going down with all that's going on in Russia and Syria and Israel and Palestine and so forth. Normally that's enough to easily get triple-digit oil. So I think it's instructive that the fundamentals behind how what's driving these things are actually in place, and with supply increases and quantitative tightening now coming into the system, we can expect that those prices will come down. Well, it's not just oil, and so we're sort of in the low $90 range for oil prices. My fundamental oil price is actually somewhere around $75 a barrel. And I know that's pretty radical, but that doesn't happen until a lot further out. Okay, so that's oil prices. Base metal prices, we believe the same logic applies to that. So we're a commodity currency, that drives our currency down. And at the same time, everybody was talking parity plus. We said, no, it's going to be low 90 cents. And we're just hanging with that forecast now. We have not had to change that forecast over a 3-year period of time. And we believe that we're okay on that. 2016, things take a little bit of a rise, but we're still in the low 90-cent zone there. What does that all mean for interest rates? We do not have to move interest rates as quickly in Canada as I believe they will in the United States. There's about a 6-month window there where we don't have to act. And it's because while they're firing on all cylinders and the economy goes up, they will have to tighten. And we believe that that's going to start somewhere around March next year and continue up to what we consider to be sort of a sustainable state threshold of 4%. So short rates will be there, and Canada will follow with a 6-month lag, but we'll do it in a stepwise pattern because we have a domestic economy that's doing this at the same time as the external sector is driving us up. We have a little bit more waiting time until we have to do that.
Dan, what do you think the greenback will do in line with Brian's?
A couple of interesting comments. One, if you look at the European Central Bank and the Bank of Japan, which is the 3rd largest economy in the world, the Eurozone is 20 or 25%. Both of those are starting to make noises about moving towards almost easier, more accommodative policy. The European Central Bank is talking about now starting quantitative easing, while Japan has done quantitative easing to the 3 times as much as we have. So we're one of the few big economies that are starting to move towards let me put it this way, a less accommodative stance. And that would make you think that most likely the US dollar is going to continue to strengthen. I'd like to make a couple of comments. One, your question was about interest rates, and one of your questions was about interest rates. And I would agree to a certain extent that the Federal Reserve has said we're going to move in 2015. I suspect they will, but I suspect by the time they do, they will be too late, because they are always too late. Janet Yellen is very dovish. She's not going to move until she's sure the economy is stable enough to endure rising interest rates. But rates will start rising, I believe, all along the yield curve. So I would also mention that forecasting out economic variables like interest rates 5 years is a fool's errand, I should think. People try it, but I think is pretty tricky. People ask me, what's the stock market doing? Well, day to day, I have no idea. The stock market moves on sentiment, on human emotion, on news, whether it's interpreted good or bad. So forecasting out things 5 years is pretty tough. And I did want to say a word about quantitative easing. So the Fed has, by quantitative easing, put an enormous amount of excess reserves in the banking system. Excess reserves that, by definition, are unused money. If you compare the excess reserves to GDP, we're at 600 times the historical level. It used to be 3 basis points excess reserves compared to GDP. It's now 15% of unused money. And that's why I think quantitative easing didn't work. It also didn't work because every time they announced a program, QE was supposed to lower interest rates went the other way. So to my mind, it didn't really, I don't think it helped the U.S. economy at all. It did create asset inflation, which we talked about. It surely did rise stock prices and housing prices, no question about that. And I think it does pose that inflationary risk out there. When you have that much unused money that might get starting used, that's a big inflationary risk. And I don't think the Fed will be able to unwind that fast enough.
All right, then I'll jump in and similar to, I won't necessarily give an explicit forecast, but I'll give like what had the paradigm, especially for rates that we see unfolding. When we think about the U.S. economy, we think that the recession will have lingering aftershocks. And so you already get that in the discussion of what neutral rates are for the United States. Our corporate view is, we put out this piece a while ago called "Is 3% the new 5%?" in the idea that when interest rates, like 10-year interest rates, get towards 5% in the United States, that's when economic growth starts to become less steady. And so the idea, if the rates go above that, you're likely going to head into a slowdown. What we basically got now is that we think that 3% is now that critical point. And so that idea, and we started to think about this last year when the Fed started to muse about ending quantitative easing and interest rates go up. And once it got up towards, the 10-year got up towards 3%, that's when the U.S. economy, to our mind, started to shimmy and shake. And so our view is that given that the idea of neutral is now lower, 5% is this new 3%, we just don't think that there's particularly any rush for the Fed to raise rates, in the idea that we think that they can go at a relatively sluggish pace. We think they start in June, but then increase interest rates quite slowly over the next couple of years. And the idea that even on the bond market, we are not basically thinking that interest rates are going to rise dramatically. And so we still look like, as rates start to get up towards that 3% level, that's the point when monetary policymakers are going to start getting more cautious. So some people are coming out with forecasts of 4% for the 10 years, 5% of 10 years representing inflation risks. We don't see that unfold. And instead we see this low rate environment to an extent extending for the next several years. So not an explicit 5-year forecast, but that's basically what we're thinking. For the oil market, commodities in general, Peter actually gave a very good exposition on that. One of the reasons why we had that big commodity rally 2002 to 2008 was because demand increased at a time when supply was restricted. If you go back to like the late 90s, if you heard about a copper mine, what did you hear? Probably it was being shut down or it was being turned into a .com somehow. In the idea about those old economy commodities, we weren't paying attention to them anymore. Everything wanted to be hooked onto the productivity miracle in the United States. Then China joins the WTO, demand for commodities leaps up, supply is restrained, what happens? Prices leap. Now we've got the supply response. So I don't think we're going to get that commodity rally that we saw in the past. And so in general, we look at commodity price forecasts as being a better supply-demand balance, just in general across the board for commodities. So neither dramatically up, neither dramatically down, in the range of where they are now, and similar with regard to some of the commodity currencies. Dollar CAD, not that much different than Peter's forecast. We see it as the Fed enters quantitative easing, Canadian dollar heading towards the low 80s, and then basically rebounding on a sustainable basis to about 90 cents.
Brian, I bet you didn't anticipate a simple question would take that. Anyway, I think there was a question down at the far end. No? There we go.
Good morning. My name's Amrit. I'm with Euler Hermes. My question is for Peter Hall. You had mentioned the housing market is heavily overburdened. With CMHC backing the mortgages, do you still see a correction in the housing or the condo market, and if so, when?
That's a great question. Normally when you get an excess like this happening in a housing market, it's at the top of the market, so everything is in sync. And so you would expect to see what one economist on the street is saying of a 20 to 30% correction in the marketplace. The reason I don't subscribe to that kind of correction is that it's not the top of the cycle at the moment. We've got different cycles happening in different parts of the Canadian economy. And so if exports, as I believe, are really going to rescue the economy, then it keeps that correction from actually happening. There's enough money flowing inside of the economy as it shifts over to the export side, and enough job creation that's actually happening on that front to keep things relatively smooth. So it's almost as if we've got a natural Keynesian style smoothing function in the Canadian economy at the moment, and I'm not sure that anybody really knows how to account for that, except that we're just the most fortunate people on the planet at the moment. So we don't have a precedent for gauging all of this. You actually have to model that in almost a very sophisticated way, where these parts of the economy are allowed to clash with each other, and then you have to look at the results and say, okay, well, what comes out in the wash? And I don't see a big price crash. If anything, there's an attenuation of the building activity that goes on, but you don't have to go much below that sustainable level. The Bank of Canada thinks it's around 185,000 units. And you can continue on at a pace like that for quite some time. It's a good question.
Any comment from the other two panelists?
Not surprised. A bit more cautious about what's going on in the Canadian housing market. Indicators that I look at show clear signs of overbuilding. I think that has to correct. It looked like it was starting to correct in 2012. That's when the federal government, they'd taken several rounds of measures to tighten the mortgage market, and it looked like housing construction was beginning to roll over and signs of overbuilding. You could see the idea, okay, we've got this smooth correction underway. Since then, overbuilding seems to have accelerated once again. And this is, you beat the data, you average it, you take it over like per population over 25, but it's a classic measure of activity in the housing sector. That tells me that we're, again, overbuilding. And whereas I'd been somewhat less concerned about the housing market, say, a year and a half ago, I'm now becoming more concerned again. I'm also becoming concerned again because of the behavior of households. When households were basically going through this period of borrowing at a slower pace, so you'd have overbuilding seems like it was beginning to dissipate. Households were beginning to borrow at a more moderate pace, closer to the growth rate of income, and say, okay, I can see the signs there of a soft landing. Now it looks like borrowing accelerating again, signs of overbuilding, and so that gets me concerned that, again, we're going to be talking about renewed concerns about a Canadian housing bubble. I actually was making comments about this a few weeks ago, and so I'm intrigued when you start seeing in the Globe and Mail and the financial press, again, signs about people talking about a Canadian housing bubble bursting. Hopefully the one thing that will be different this time is that we'll get more reasonable discussions about that. A couple of years ago, when you'd hear signs about the Canadian housing bubble, the inevitable picture was the cranes in Toronto. And it pained me to talk to people saying, like, look, the building in Toronto and the Canadian housing market are different beasts. And so don't necessarily confuse one with the other. And I still think that's very true. So I don't count the number of cranes in Toronto as a sign of the Canadian housing market. But these other indicators do indicate to me that the Canadian housing market is again overstressed, and I do foresee a price correction. Not a sharp price correction, but I do see prices correcting over the next couple of years. But again, I would say I expected that 2 years ago, I expected that last year, and so I'm still one of those people who's waiting for that to unfold. But whereas in the past I had greater confidence that it would be a soft landing, I'm getting more concerned that it might be I won't say disorderly, but a more difficult correction unless we start seeing signs of the housing market beginning to cool off once again.
This end, nobody has really had a chance. That end's winning the competition. The draw for the trip to Hawaii. Oh, there we go. We got one. And I'm going to make this the last question. So make it easy. Oh.
Try my best here. Don Horn with Insurance Business Magazine. You see a number of studies out there and some noises coming out of various levels of government. More infrastructure is needed. Out of Calgary, I believe, there was a $2 billion price tag put on mitigation for future flood events. And Toronto, I mean, all the politicians are making noises about building subways, perhaps as far north as Aurora. How can the investment side maybe push this agenda ahead and maybe spur investment to perhaps move the economy ahead as well?
How? I'll jump in there. That's a difficult one. Numbers I look at, we've got an infrastructure gap in Canada. The Federation of Canadian Municipalities estimates an infrastructure gap of $200 billion, over $200 billion. And that has to be spent over the next 10 years. So that's just to get us to where we need to be, not necessarily taking into consideration, say, the building in Toronto, the building in BC that requires even more infrastructure on top of that. In terms of the investment in Canada, it goes far beyond that. If you look at just in the natural resources sector, over the next 10 years, we need investments totaling $675 billion. That's only natural resources and infrastructure. Then you figure the manufacturing sector and the rest of the economy, all of a sudden get to the point that we need probably well over $1 trillion in investment in Canada over the next decade. We're not alone in that. China's going to have huge investment needs. India's going to have huge investment needs. What we basically need is Canadian businesses and governments to realize it's going to be competition for this capital, and we have to start getting that spending done. And how are we going to do that? In Canada, one of the ways that we could do it is we could either do it funding it domestically or funding it by borrowing internationally. Borrowing it internationally, there's going to be a lot of competition. I think what we have to do in Canada, and this gets into the housing sector as well, is we have to save a lot more as households, governments, and in order to allow, and businesses in order to allow and fund that investment more domestically. Because if we don't, we are going to have to go increasingly into the global markets, and there's going to be intense competition for investment funds. So from my perspective, one of the things that we have to do is bring out, especially say from the household sector, from, if you want to say, government ideas, measures to cause Canadian households to begin to save more. We've been borrowing for the past 2 decades, and that is done. And what we have to do now is from either the infrastructure side, the investment side, and also from the idea of the aging baby boomers, we have to save a lot over the next decade in order to fund the spending that's in the investment that's going to have to be done over the next few years, so that we don't have to be as reliant on foreign investment. Because one of the things about foreign investment that is curious is foreign investors come into the economy, and if all of a sudden they get disappointed, they can always leave. And so if we continue to rely on foreign investing for a lot of the investment we have to do domestically, it leaves us vulnerable to capital flight. And so I think the best solution for Canada would be, while we still have to rely on some foreign investing, do a lot more domestic savings so that we can fund a lot of it ourselves.
Peter, can I give you 2 sentences in response?
You know that that's impossible for me to do.
Well,
No,
that being said,
just a quick comment. I will be very fast here, but I would say that in answer to your question, P3s are a way that are going to open up an avenue for this. And my sense of what's going on in Ottawa, at least with respect to creation of infrastructure, is they're almost apoplectic about what happened to trade infrastructure last winter. Now, that was an unusual sequence of events that happened, but it was the crisis that I believe is a necessary precondition to the transformation of our trade infrastructure. I would take what David says about our infrastructure deficit and say it's the trade infrastructure deficit that I'm most concerned about, because if that's the part of the economy that has the most hope, if we have log jams there, the business is going to go somewhere else, even the agri-food business. And so I believe that the urgency around that is well understood, and I hope that translates into real activity. That's all I'll say, Bob.
Dan, I'm going to cut you out, being the fact you've come to us from America. And no doubt you'd like to see Canada spend. Ladies and gentlemen, I hope your brains are full. I do know that your bladders likely are. So I am going to knock this down. Thank you very, very much for coming. I certainly appreciate being the moderator of such a prestigious panel, and so well educated, so well experienced, and certainly clairvoyant as to where we're heading. I'm going to turn it back to the chairman of the Receivables Insurance of Canada. And I think I made a faux pas when I talked about Tory, and I think I said Chung, but I meant Chow, because I'm likely going to be in real trouble from the media. And I apologize to Olivia. Away you go.
Thank you, Bob. I'd certainly like to thank Bob for a job well done, and Bob, you didn't disappoint us at all, so thank you, Bob, very much. Thank you. I want to thank everybody for coming out. I know it's busy. We try to do it early so that you can get back. It's everybody's busy these days, so again, really appreciate your time. The Receivables Insurance Association is a relatively new association. So for us, these type of meetings and pushing membership forward is very, very important. So if you are interested in becoming a member, you can visit our website at receivablesinsurancecanada.com. And there's a bunch of information on that. I want to thank, obviously, our speakers here, Dan, David, and Peter. Really appreciate it. Sort of mutually agreed upon. Typically what we would do is present sort of a gift, I guess, for speaking. And what we're going to do is we're going to make a donation on their behalf to a specified charity. So Dan, if I could present you.
Oh. Thank you very much.
Dan, thank you very much.
Yes, thanks. And this is it's a donation to one of our company's favorite charities, which is the Johns Hopkins Children's Fund, which helps very sick children from all over the world. So thank you very much.
Thank you. David?
All right. Thank you very much. Hopefully, I think I know what I said. Mine's to the Alzheimer's Society, basically because, my mother's afflicted with it, so personal sort of issue there.
Thank you. Peter? Sorry. Thank you very much.
Mine is Faith's Orphans Fund. It's a fund that's run in Zambia, Africa. This is a woman who has taken it on herself to bring in orphans who have been orphaned by the AIDS crisis in Africa, and so that's one that's especially close to my heart. Thanks very much.
Great. Thank you. So just to wrap up, I certainly want to thank everybody again for attending. I want to thank the board of directors and members for their participation, for their help. In particular, I want to thank David Deanish, who has put in a lot of time and effort here, working with our marketing membership committees. So David, thank you very much. A lot of work. And I hope to see everybody out at future events. Again, thanks for your time. Have a great day.